The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not. So what does a diversified portfolio look like? Well, I have a slice of stocks. I'm not anti-stock market, but you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, yeah, but I recently invested in a lithium mine. I think the climate alarmists, I think the Green New Deal, I call it the Green New Scam. It's a scam, but it doesn't mean it doesn't have legs, whether you like it or not. The fact is, it's going to go on. So the lithium's in short supply, graphite, et cetera. So there is a portfolio you can have, which is natural resource oriented, that will do well, even in the kind of tough environment we're talking about. Slug of cash, absolutely, maybe as much as 30%. I like treasury notes, 10-year treasury notes, but seasoned to taste. If they're a little too volatile, look at 5-year notes, 2-year notes. They're going to come down a lot, not right away, not tomorrow morning, but sooner than later, because of everything we discussed, which is a recession, and interest rates will follow. They're a lagging indicator, but that'll happen. Gold, I always recommend 10% slice. Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously, basic bond math, interest rates come down, the price of the bond goes up. They're just inverted. It's a little counterintuitive, but rates come down, the bond goes up. The question is how much? And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher. As the DV01 is higher when the rates are lower. Again, it's all counterintuitive, right. But the lower the rate, the greater the capital gain on each basis point drop. That's the basically. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you got a nice fat capital gain. Yeah, but based on what we were talking about, I would get silver dollars, American silver eagles. Yeah, a monster box. That's bit of jargon. Monster box comes from the U.S. Mint. It's treasury green, nice shade of green. It comes with a compression strap. I recommend don't open it, unless do not break except in case of fire. But inside are 500 1-ounce American silver eagles. That's a lot. They'll feed your family for probably a year, and they run. It's a market price, but be around $10,000-$12,000 for a monster box. But to me, it's like battery and flashlights. Just have one, stick it in a safe place. Yeah, I like them both. And, I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist, but I do think about it from a monetary perspective. And then people always say, Jim, what about silver? What about silver? I'm like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver is a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the quarter ounce American gold eagle, still $500. It's like pulling a $500 bill out of your wallet. You know, it's a lot for groceries. Yeah, income producing real estate. I wouldn't get into commercial real estate, residential. Yeah, the prices are, home prices are coming down a little more in some markets than others. But if it's income producing and it's solid and it's in a place like, someplace people want to be, like Austin or Phoenix or whatever. I mean, I know there's markets down a little bit right now, but it's like buying a 10-year bond. It's got steady monthly income and or certainly farmland, but income producing real estate, not commercial office buildings, should be a part of a diversified portfolio. Yes. I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But, there's some, some good deals in the mining sector. I like, seriously, everything we talked about is sort of pales in comparison to what's going on in Ukraine. We're kind of on the march toward nuclear war. If you talk about what they call legacy media, mainstream media, so Washington Post, New York Times, LA Times, NBC, ABC, CBS, MSNBC, CNN, that run of characters, the first thing you discover is, I know a lot of these people. I've been on all these programs. I've done this for a long time. I spent a lot of time in Washington, had dinner with most of or lunch or whatever, dinner actually more often with most of the names you've heard about. Some of them are fine, some of them nice. A lot of them are either not that bright, or, they're good on camera, or whatever. They got a desk at the Washington Post. They're not that bright. Or if they've got some degrees, they've been kind of indoctrinated. We're at the point now. A lot of these people are 28, 33, 34 years old. There's nothing wrong with that. That's, good. You're in the heart of your career. But that means they graduated from school in, 2016, 2017, or whatever. And they're thoroughly indoctrinated. I went to school when we learned, it was pretty rigorous. I had one program where they graded, you needed a C+ average to graduate, but they graded on a C- curve. So you're like, how do you get it? How do you even get a C+ if they're grading on a C- curve? The answer is people quit. In other words, you were trying to struggle to be. I did get an A in partnership taxation. I'm proud of that. But the standards are down. The mission standards are down. Affirmative action takes over. When you get into the classroom, I don't care where you're at, Ivy League, whatever, it's just indoctrination. The market has a way of sorting it out. If revenues are down, advertising's down, viewers are down, subscriptions are down. Eventually, as you said, they will go out of business, not overnight, and then new media channels will arise. And there's a lot of garbage on the internet, but there's a lot of good stuff. And if you want to keep tabs on the war in Ukraine, you have to know where to look. It's not easy, but there are a number of channels and I'm talking about, military officers, colonels, brigadier generals, people on the ground in Ukraine, not, some studio in New York. You can find out what's going on. But I think my intelligence training is helpful because you have to be very persistent and know how to dig. We may have a very bad recession, possibly worse than 2008. So tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay, yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets where you ended up losing everything, but for a couple of days or weeks even, it's, hey, the bottom's in, and you buy stocks, etc. So you have to watch out for that. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of that. Some of the buy the dips people are still around, so count on them to buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the NASDAQ dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. That's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are two huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling you what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked, but it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later, but that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people, because, and particularly if you're using 2008 as a frame of reference, there are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 19, 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but but they can happen separately. My point is, what's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain, we all remember headline, supply chain's broken down, the shelves are bare. So all true. That was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, well, or tripled the orders. They said, well, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff, retail sales drop off a cliff, the warehouses go from being empty to being full to the rafters, and now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness. The Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve and their focus on the unemployment rate, which is not a good measure of what's going on in the labor force. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. Supply chain is not part of the economy. Supply chain is the economy. In other words, if you want to understand the economy, you're really talking about the supply chain at every aspect. Something as simple as a loaf of bread. You buy a loaf of bread at the grocery store. Like, okay, well, I guess it came from a baker, and I guess they took it from the bakery to the store by truck. So there's a supply chain. Well, that's about as simple a version of the supply chain as you can imagine. You have to just start going from there. It's like, well, did the bread come in a plastic wrapper or a paper wrapper? Well, that wrapper came from somebody. Where'd the truck come from? Well, obviously a truck manufacturer. Where'd the driver come from? Somebody had to make a career choice and be trained. And what about the diesel fuel in the truck? That came from a refinery, and that came from oil exploration. Then you get back to the baker, and it's like, oh, well, I guess he had an oven or she had an oven. Where did that come from? And then you find out that the ovens are, industrial ovens have parts from 25 different countries and so forth. Well, without belaboring that point, you get back to the farmer and the wheat and the fertilizer and everything else, and really what's called the extended supply chain. And you're like, wait a second, that's a huge number of countries, a huge number of imports, and a big part of the economy, which it is. And then every link in that supply chain I described has its own supply chain behind it to get to source materials and intermediate manufacturing and so forth. And then that's for a loaf of bread. Well, what about your car, your furniture, your clothes, and on and on and on. Once you start thinking about what supply chains are, you realize it's just the cardiopulmonary system of the entire global economy. So, the supply chain book shines a light on the entire global economic process. And I have whole chapters on that talk about China, the war in Ukraine, and climate change. And you say, well, the interesting topics, but what do China, Russia, and climate change have to do with the supply chain? Well, the answer is they are, kind of global macro earthquakes. Russia's invasion of Ukraine led to sanctions against Russia that affect everything, imports, exports, strategic materials, semiconductors, fertilizer, oil, natural gas, etc. Again, you're saying, well, okay, Boeing makes aircraft. They need titanium and aluminum. Where does that come from? Turns out about 30% of it comes from Russia. So how are you going to keep the Boeing assembly line going when you're shutting down strategic metals from Russia? I can go kind of on and on there. China, everyone says, well, they slowed down because of the zero COVID policy. And that certainly has been detrimental to their economy. Shanghai, a city of 26 million people, Beijing, a city of 22 million people, they were both locked down entirely last spring. When I say entirely, no transportation in or out, nobody on the streets. You had some essential workers. People had to get to work. You had to have a COVID test, a negative result that was not more than 2 days old. So these were extreme lockdowns and obviously very, very detrimental to the economy. Now, those have died down a little bit, and China's saying, now we're going to relax our zero COVID policy a little bit. So what's new? Why are supply chains breaking down? What's new about the supply chain that makes it different than any other period in the history of the world? And what's new were two things, and they arose around 1989. The first was you had a combination of increased computing power, algorithms, artificial intelligence, better data collections, and new models. So you suddenly had the computational telecommunications and data and mathematical tools to be a lot more sophisticated about how you handle the supply chain. But the second thing that happened at the same time was 1989, the fall of the Berlin Wall, 1991, the collapse, the demise of the former Soviet Union, which gave rise to new trading partners in both in Eastern Europe, where they were no longer behind the Iron Curtain, Poland and Romania and Hungary and many other countries. And at the same time, you had the rise of China. China did have a fairly high growth period in the 1980s, but nothing like we see today. And it all came crashing down in 1989 with the Tiananmen Square massacre. And that really shut down U.S.-China relations, not fully, but there was no Western investment coming into China. The two countries were distant. Well, that ended around 1992. Deng Xiaoping did what he called the Southern Tour, where he reaffirmed China's commitment to capitalist principles. They weren't overthrowing communism, but they were embracing capitalist market ideas. There was a thaw in U.S. relations, and then it was like, no holds barred. Then that's when the U.S. investment really did pour in. So all in a short period between 1989 and 1992, you had the fall of the Berlin Wall, the fall of the Soviet Union, new republics. China kind of re-enters the game, and all this was globalization. So now all of a sudden you had the science I described, computing and artificial intelligence and applied math, and a true global market. So now the supply chains could go 9,000 miles from Chongqing to New York, or from Shanghai to Seattle, or London to Hong Kong, of course. So this was true globalization, much larger scale, much longer supply chains, and it worked. And so this was a period I call supply chain 1.0, 30-year period from 1989 to 2019. Now, why did it break down around 2019? Three things. A lot of people look at the pandemic and they go, oh yeah, COVID, that disrupted everything. That was the problem. And some people look at the war in Ukraine and the Russian sanctions and go, that was the problem. And they both made it worse. They both made it worse, no doubt about it, made the supply chain worse. But it really started in 2018 with Trump's tariffs on China. So Trump put tariffs on appliances and solar panels. Well, China didn't stand still for that. So China said, well, what can we do to strike back? Well, at the time, China was and is the world's largest importer of soybeans. They need the protein. They don't have enough. The U.S. and Brazil are the two largest exporters of soybeans. Well, China was buying all their soybeans from the United States because they were trying to reduce the trade deficit. We were buying so much stuff from them, and China said, well, what can we buy from the U.S. just to kind of balance the books a little bit? And the answer was soybeans. Well, when Trump put the tariffs on, China redirected all of their soybean orders to Brazil. They stopped buying U.S. soybeans and they bought them all from Brazil. Well, there's a lot more to that than a phone call. You got vessels and dry bulk carriers and transportation lanes and port facilities. And, if you're Brazil and you get all these orders, you got to get trucks to get the soybeans to the ports. You got to open up port facilities, et cetera. The point is, this is a major, major shift in global logistics, just to change the order book from the U.S. to Brazil. Beyond that, people involved in this, they don't want 6-month contracts. They want 5-year contracts, or at least 3-year contracts, and they got them. And so now all of a sudden, China's buying all their soybeans from Brazil, but this scrambled global supply chains. Now, what are the U.S. farmers doing? We're still growing the soybeans. We can't sell them to China. Well, it turns out the Netherlands needed them. So, okay, we'll sell them to the Netherlands and distribute them to Europe, which they did. And then this went on and on because Trump put more tariffs on to retaliate. China took more actions against the United States, canceled purchase. So, and it escalated from there. Now, again, COVID made it worse. The war in Ukraine made it worse. But it's very clear that that's where it started. So that's why I use 2019 as just, kind of an arbitrary date with a 30-year period of supply chain 1.0. Now we're getting to supply chain 2.0, but we're not there yet. We're in this like messy, in between, inefficient, muddling through period where things are broken, but they'll never be put back together the way they were, but we haven't produced or created the new model supply chain. We're just muddling through, and with a lot of disruption, a lot of empty shelves. You have to understand, it took us 30 years to build this. We blew it up in about 3 years. It's not going to come back overnight. It's going to take 5 or 10 years, or maybe longer, to rebuild in some form. The first point I would make is that global recessions are rare. Recessions in individual countries or economic communities like the EU do happen with some frequency, but a global recession is different. It's usually the case that even when a large group is in recession, somebody else is expanding. China, the 1970s used to call the U.S. the locomotive. If Germany was in recession, somehow the U.S. could kind of power through, although the U.S. itself had 3 recessions between 1974 and 1982. But a world recession is rare. We had one around the time of the 2008 financial crisis, even though Australia did power through it, okay, and certainly in 2020 during the pandemic lockdowns. But they're unusual, as I say. It's usually one group is in a little bit of trouble, but another group powers through and even can pull the recession country or group out of difficulty. But when global GDP declines, that's rare. We are heading for exactly that. To understand that, let's take a look at some of the largest economic groupings, and I'll start with the United States. Now, the United States had a mild recession in the first half of 2022. If you blinked, you missed it. First quarter GDP was negative, not a lot, about 1.6%. Second quarter GDP was also negative, about 0.9%. So first half as a whole, we had negative GDP. The rule of thumb definition of a recession is 2 consecutive quarters of declining GDP. That's the rule of thumb. We had that. It's in the data. Having said that, it was mild, and third quarter GDP and fourth quarter bounced back. But if there was a recession, it was mild. What I'm talking about is a much more severe recession, much more difficult, much sharper drop in economic output, beginning about now with rising unemployment, slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, if the Fed raises rates the way I've described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks or buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way. I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might. But what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned, because as I say, the Fed's going to over tighten. Now, why doesn't the Fed know this? Well, because they never know, because they have the worst forecasting record of any institution I can think of. Their entire history since 1913 is one blunder after another, and this will just be the latest in a long series. And so, just to kind of summarize, the Fed's on a course. We know exactly what it is because they told us. All you have to do is listen to them and believe them. They're going to raise rates, let high rates do its work, do their work, and see the inflation come down, and maybe in 2024 cut rates. What I expect is they are going to raise rates for the next couple of meetings, exactly as I've described, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to finish on can't call it a happy note, but global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like your liquidity crisis? No, a recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, a recession or depression and a financial panic converged. So they can happen together, but they don't have to. They can happen individually. What we're in for looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? Well, what people don't understand is that behind the curtain, off balance sheet, this is off balance sheet. You got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with the Q word, 1 quadrillion is 1,000 trillion. So I just said the Fed printed $9 trillion. Maybe it's down to $7 trillion. Yeah, but you have 1,000 trillion of derivatives, and they have to be supported with collateral. Not 100%, not even 10%. I mean, kind of 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. And right now, what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year Treasury notes as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge. It's by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the U.S. dollar is so strong. People go, wait a second. The U.S. has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets. What's driving the demand for dollars is the need to get dollars to buy dollar-denominated collateral, specifically treasury bills, to post as collateral to support the $1 quadrillion of derivatives. And that's going to persist until the system crashes, which it's in the process of doing. I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear, fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way, way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1 worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And they look into the future. Here's the forecast. They pick out a discount factor, they present value it and say, here's where stocks should be today based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's, well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. And there's a number of different techniques. And what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But, it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested in whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, and a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point, is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to save. If you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired a guy down the hall, but maybe I'm next. And maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold. The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Euro-dollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a a big red siren, a flashing light, whatever you want to call it. Okay, whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. So those spreads will blow out. And it's important to remember, interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. The yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I said, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. Interest rates peak after the recession has already begun. So interest rates may not have peaked yet. Even the treasury market. So that's not unusual. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statute, SEC. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect. That unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality, and I guess I'm the storyteller here, but what I see is a kind of a hybrid The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened, and they may pivot to say that there could be a rate cut in August. Maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened. They tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. So basically, they copy the World Bank, they copy the IMF. And I want to make 2 points. Number one, it's not like the BRICS popped up 6 months ago and said, hey, we're going to have a new currency. It's like Mickey Rooney and Judy Garland putting on a play. This has been in the works for 17 years. And it's typical Russian, Chinese. They kind of run a show, very methodical. So they duplicated the World Bank. They duplicated the IMF. Now they have applicants for membership, and there are, I think, 21 or more countries who have applied. Well, 7 have formally applied for membership. They filled out their college essay and they want to be members. And then another 13 or 14 on the waiting list, so to speak, and will perhaps eventually become members. But when you add those in, some of these will be admitted in August 22nd. That's the next big meeting, starting with Saudi Arabia. So what happens when you let Saudi Arabia into the BRICS, given the other members? You have 2 of the 3 largest oil producers in the world, Russia and Saudi Arabia. You have 2 of the 3 largest nuclear arsenals in the world, Russia and China. You have, throwing India in, and some others, you have about 50% of global population, 54% of global GDP using purchasing power parity. You can debate the method, but just if you do purchasing power parity, you get over half of GDP, 30% of the global landmass. I could go on and on. My point is that I learned development economics in the 1970s. We had something called the third world. It was Russia or Soviet Union and the US, and then there was the third world. And all you knew about them was they were poor, and you had to get them off the runway. We actually had the runway theory of how you grow. Turned out to be wrong, but that's what we learned. Well, this is not the old third world. These are not basket cases. These are many of the biggest economies in the world that collectively have enormous power, natural resources, gold reserves, landmass, population, military. And again, I could go down the list, but this is a bloc that is as powerful in its own way by a lot of these metrics as the collective West, which I would call, US, Canada, Western Europe, Japan, Australia, New Zealand, and a few others. So that's who this group is. Now, there are a couple other groups that may join forces with the BRICS. There's something called the Eurasian Economic Union. Everyone's like, what the heck is that? Well, the EEU was Putin's answer. And this has been around for a long time. This goes back to the early 2000s. This was Putin's answer to the EU. He said, well, you got the EU, we got the EEU. Now it's Russia and some Central Asian republics, Belarus and Tajikistan. I'm not saying this is France, Germany, and Italy, but it is a group that have reduced tariffs and improved trade between themselves. And there's another powerful group called the Shanghai Cooperation Organization, or the SCO, led by China. And these are mostly Central Asian republics, including Kyrgyzstan and Kazakhstan and some others. But they're all talking to each other. Now, what's the common denominator? Well, it's basically Russia and China. China's a member of 2. Russia's the only country in the world that's a member of all 3. So through pretty simple inference, you could say, hey, Russia and China are running the show. And it's very likely that when this new currency plays out, that those other countries will join in. When you do that, And I found a really cool widget. It's a map of the world that's blank, and you can go country by country and fill in by color. Just click on it and give it a color. And I did that. And I was like, oh, okay, here's the BRICS, it's 5 countries or whatever. Well, here are the applicants, it has another 20. Here's the SCO, a few more. Some of them are members of both. Here's the EEU, has a few more. Again, many are members of both. And you keep going. And all of a sudden, like a light bulb goes on. I said, that is Halford Mackinder's global island, what he called the world island. And this goes back early 20th century, first, probably greatest geopolitical theorist in history. Got to read his book if you haven't read it. It's pretty short. But he had this idea of the world island. That is exactly what they're building. Now, why is that important other than the obvious, which is more collective economic and population power? By the way, output of wheat, pick your metric, this dominates the world. Well, for one thing, if you're going to have a currency union, the more countries you have, the more likely you are to be successful. Why? Let's just kind of digress for a second. And what are the headlines saying? Again, you correctly said, haven't we been talking about this for 10 years? Well, yeah, actually we have. But in the past year, what are the headlines? China and Saudi Arabia are talking about selling oil for yuan. Brazil and China do large multi-product currency deal where they accept each other's currency. UAE, China, same thing, selling oil for yuan. Russia, China, using yuan and rubles as payment methods for whatever they sell to each other. Russia sells natural resources, China sells semiconductors, manufactured goods, and so forth. And there are a number of those. I don't have to list them all, but there are 10 or 15 of these. The reason they've all fallen short, and very few of them have actually come to fruition despite the headlines, is when you have two countries and they're going to trade with each other and accept each other's currency, and you can do that, you're limited to what you can do with that currency. This is why the Russia-India thing is starting to break down. Russia's been pumping oil to India. India's been paying in rupees, but how much curry do you need? I mean, and Russia's starting to balk. They're like, hey, we're up to our eyeballs in rupees. We need a better system. Well, when you have a multilateral, multi-country currency union, that problem goes away. Russia sells oil to China. China pays in BRICS, the BRIC currency, pays you in BRIC. But Russia can take the BRIC and turn around to Argentina and say, we'd like to buy, or Brazil maybe, and we'd like to buy some Embraer aircraft. And Brazil gets the BRIC currency, and they can turn around to China and say, we'd like to buy some rice. And then China takes, et cetera. And so you've solved the quasi-barter problem. You've solved the problem of what to do with a pile of currency that you really can't use other than certain goods and services, but not everything you want. And there's an analyst who's brilliant. I read his stuff all the time. I'm like, man, you're so smart. And I just really follow him very, very closely and give him a lot of credit. But he came out a few days ago, maybe a week, and said he'd heard about this and he was kind of dismissing. He said, you can't have a currency union without a common fiscal policy. And I said, I don't want to mention his name, but I said, have you not heard of the euro? I mean, there is no common fiscal policy in Europe. Don't tell me that Italy has the same fiscal policy as the Netherlands or that Germany has the same fiscal policy as Greece. They don't. They do have a central bank that issues the currency, has a little bit of gold, but not a lot relative to the size of the economy. But there's no common fiscal policy and there's no common bond market. To this day, there's no such thing as a bond, I'll call it a Eurobond, backed by the full faith and credit of the entire European monetary zone. It doesn't exist. You can buy German bonds in euros. You can buy Italian bonds in euros, but you can't buy a Euro bond backed by all those countries. So they don't have a common bond market. And they don't have a common fiscal policy, but they do have a currency union that's very successful. They finally have the scale. They finally solved this problem, which I described, which kind of is not, when you got two countries, you're not too much further ahead than barter, but with 30 countries